Welcome to Iron Financial. This is the only place where we help you forge a stronger, more resilient portfolio and absolutely cut through all the market weakness. I'm your host, and today we are putting the structural integrity of a true biotech behemoth right under the microscope. We're talking about Amgen, and we're breaking down their highly anticipated Q1 2026 financial results. We're going to strip away the noise and look directly at the rivets holding this entire company together. Listen, right now, the biotech sector is at a dangerous crossroads. We've got massive patent cliffs looming over the entire industry, and capital is getting incredibly expensive to borrow. So Amgen's Q1 report isn't just another earnings explainer, it's honestly the ultimate litmus test. Can legacy giants actually pivot, or are they just going to slowly bleed out? We need to figure out if Amgen is actually building real value, or if we're just looking at hype that's masking some serious foundational issues.
So that brings us to the core question we have to answer today. Amgen, ironclad growth, or rusting giant? Now, the thesis I want to lay down first, which comes straight from Amgen's CEO Robert Bradway, is that 2026 is a springboard year for the company. The idea is that they are purposefully building a launchpad for the future, leveraging their rapidly growing products to completely offset the expected financial hit of all those patent expirations. But a springboard sounds absolutely great right up until it snaps under your own weight. So we're going to run a rigorous stress test on these financials. You literally cannot just offset massive exclusivity losses with a couple of good quarters. We've got to dig deep into the balance sheet, the margins, and the debt to find out if this stock is a trap disguised as an opportunity. We need to know if that springboard is forged from solid steel or just cheap tin.
And speaking of heavyweight, we have to start right here. $57.3 billion. That is the massive debt load currently hanging over Amgen's balance sheet as of March 31st, 2026. What's actually kind of concerning is that this number increased from $54.6 billion at the end of 2025. So that's a $2.7 billion jump in just 3 months. How on earth can any company carry this kind of heavy lifting without its foundation cracking? Well, the crucial point is how they manage that weight. Sure, the debt is heavy, but Amgen isn't buckling. You have to pair that $57.3 billion debt with their liquidity. They're sitting on $12 billion in cash and cash equivalents, up from $9.1 billion at the end of 2025. Plus, they generated an incredibly strong $2.2 billion in operating cash flow this quarter alone. They aren't just hoarding cash, they're strategically deploying it to actively manage debt maturities while still securely funding their dividend. Basically, they have the reinforced concrete necessary to support this leverage while they transition. Let's move right into Section 1, Top-Line Steal. Examining Amgen's Q1 revenue foundation. Now that we've addressed the balance sheet, let's really drill down. In any construction project, you absolutely must examine the structural integrity of the foundation before you even think about evaluating the penthouses. We're going to look at Amgen's top-line revenue foundation to see exactly what is supporting their daily operations. And here is your proof of a solid base. $8.6 billion in total revenue for the first quarter of 2026. This figure represents a highly resilient core. It shows us that despite all the market volatility, despite the intense, cutthroat competition in the biotech sector, Amgen has the operational muscle to generate massive, consistent capital. And that momentum is brilliantly illustrated when we look at the comparison. Total revenue grew cleanly from $8.1 billion in Q1 of 2025 to that $8.6 billion in Q1 of 2026. That is a solid 6% year-over-year revenue expansion. They are expanding their footprint, plain and simple. But the market skeptic in me has to ask, is 6% really ironclad growth? Is this modest increase just a fresh coat of paint? Because when you factor in sector-wide biotech inflation, rising clinical trial costs, and incredibly aggressive pricing pressure from pharmacy benefit managers, is 6% truly enough to keep up? We really need to see how efficiently they're converting that revenue into actual bottom-line power. That brings us exactly to the margins. 45%. That is Amgen's non-GAAP operating margin as a percentage of product sales for the quarter. This is huge. It proves that Amgen is highly efficient at forging absolute profits from its operations. Even with the heavy investments they're making for the future, they're maintaining this massive 45% margin. How do they do it? It really comes down to total operational discipline and immense pricing power in their specialized markets. They are actively optimizing their manufacturing footprints and aggressively controlling their headcount costs. Management explicitly stated they expect a similar margin next quarter. So they aren't just bringing in the cash, they're keeping a massive chunk of it. And what does that 45% margin actually translate to? It translates to this, $1.5 billion in free cash flow. This right here is the mortar holding the company's growth initiatives together. And the proof is in the cash generation itself.
free cash flow is up significantly from the $1.0 billion they generated in Q1 of 2025. That is a 50% increase year over year. You guys, this liquidity is exactly what allows them to pay those dividends, invest heavily in R&D, and successfully manage that $57.3 billion debt load we hammered on earlier.
All right, moving to Section 2, heavy lifting, the 16 pillars of Amgen's growth. Let's move to how this all builds into their specific product drivers. We are entering the phase of the explainer I call the heavy lifting. Amgen's overall 4% product sales growth was actually driven by 16 distinct brands achieving double-digit growth. Furthermore, 17 of their products are now annualizing at sales of $1 billion or more. These aren't just single beams. These are 16 massive pillars, keeping the company's revenue structure perfectly intact. And the absolute foundational heavy lifters right now, Repatha and Evenity. These two innovative medicines are literally carrying a massive portion of the growth burden. Repatha is benefiting from real-world adoption, increased treatment urgency, and expanded guidelines for cardiovascular patients. Meanwhile, Evenity is completely dominating the bone health space, snagging a massive 65% market share in the US alone.
Now, the clinical story sounds great, but at Iron Financial, we're all about the numbers. Let's strip away the marketing speak. Here's the raw data. Repatha generated $876 million this quarter. That is a massive 34% surge year over year. Evenity delivered $562 million, climbing a staggering 27% year over year, and that was driven by 35% growth just in U.S. sales. This is explosive, double-digit iron-forged growth. But again, skepticism is healthy. Can this exact momentum genuinely outpace the impending patent cliffs? Are these new pillars rising fast enough to support the roof before the old pillars crumble?
Well, they aren't just relying on two drugs. Take a look at Tezspire. This is another crucial layer of steel added directly to the portfolio. Tezspire brought in $343 million, which is a really robust 20% increase. This expansion is being directly supported by the adoption of new indications. They are literally reinforcing their foundation block by block. But we have to question the SG&A toll here, the selling, general, and administrative costs. Launching new indications into entirely new respiratory markets requires heavy, intense marketing expenditures. High revenue growth is a great headline, sure, but if it requires hundreds of millions in physician education just to move the needle, the net strength added to the foundation gets a bit compromised.
That being said, the structural integrity of Amgen is incredibly diverse, which actually shields them from those specific launch risks. Let me methodically walk you through the broader portfolio. Their rare disease unit delivered $1.2 billion, up 25%. Within that, Eplizna sales absolutely surged 188% to $262 million, and Tepezza grew 29% to $490 million. Then you've got innovative oncology producing $1.8 billion, also up 25%, led by Blinzido at $415 million and Imdelltra at $258 million. Finally, their biosimilars portfolio contributed $835 million, a 14% increase. Let's just stop and appreciate the architecture here. Having a highly profitable, cash-generating biosimilars portfolio acting as a counterweight to the incredibly capital-intensive innovative oncology unit, that is a brilliantly smart structural move. The biosimilars provide reliable yield that directly funds the high-risk oncology pipeline.
Okay, we've seen the fortress. Now it's time for Section 3, cracks in the armor, debt, erosion, and margin pressure.
Welcome to the cracks in the armor. You cannot evaluate a portfolio addition without actively looking for the rust. We already discussed the heavy debt load, but now we really need to look at the structural erosion and the intense margin pressure quietly eating away at Amgen's bottom line. The old guard is dying, and it's taking a massive amount of cash right down with it. This is the ultimate internal tug-of-war happening inside Amgen right now. Just look at this juxtaposition. On one side, you have the build, Repatha's extremely impressive 34% growth. But on the other side, you have the bleed, a terrifying 32% decline in their legacy products, Prolia and Xgeva. Every single brick they lay with the new drugs is fighting against the fact that their old foundation is turning to dust.
Let's actually put a firm dollar amount on that bleed. The loss of exclusivity for Prolia and Xgeva resulted in a combined sales decline of $1.1 billion in a single quarter. Let me repeat that because it's crucial. A massive $1.1 billion hole was just torn straight into the company's foundation. The ongoing accelerated erosion of these legacy brands is a stated operational risk. So the billion-dollar question is, how long can the new drugs genuinely cover a billion-dollar gap before the whole structure caves in? And guys, it's not just revenue erosion, it is margin friction. Amgen's non-GAAP cost of sales reached 19.5% of product sales this quarter. Why? Because of higher profit sharing, royalty expenses, and negative changes in the sales mix. This 19.5% is acting exactly like structural friction, just slowly eating away at the bottom line. Management even admitted they expect further pressure here. Let me tell you why this specific phase of their transition makes profit sharing so dangerous. As their newer partner drugs grow faster than their older wholly owned assets, their blended margin profile gets structurally weaker. The more these new drugs succeed and grow, the more royalties Amgen is contractually obligated to pay out. It's an incredibly expensive way to build a business, and it acts like a heavy anchor on their future profitability.
All right, let's look forward. Section 4, Blueprints for the Future. MariTide and Raise 2026 Guidance. I know that erosion sounds scary, but we have to look at the broader blueprints. Management is entirely aware of the legacy decline. They aren't just managing a decline, they're actively building for a highly profitable future. Listen to this quote from CEO Robert A. Broadway. With a new wave of molecules progressing in phase 3 clinical development, we're confident in our ability to deliver attractive long-term growth. They are aggressively advancing their pipeline. The MariTide clinical program just initiated multiple phase 3 switch and maintenance studies. And let's be absolutely clear about why MariTide is a potential game changer right now. In a market totally flooded with daily or weekly weight loss treatments, MariTide's differentiated, less frequent dosing profile is a massive structural advantage. They are looking way beyond the current erosion to an entirely new era of dominance. Now, is confident in our ability just standard CEO talk? Phase 3 trials are notoriously expensive, and there's never a guarantee of regulatory approval. Yes, they are incredibly expensive, but Amgen is putting its money exactly where its mouth is. Look at this 16% spike in non-GAAP R&D spending. It jumped from $1.48 billion in Q1 of 2025 to $1.7 billion in Q1 of 2026. This isn't wasted capital. This is the absolute necessary heavy lifting required to advance critical late-stage investments like MariTide, Olpasiran, and Deltra. They're heavily investing in AI-driven R&D to increase efficiency. This is what a company forging its own future actually looks like. And you know what? That confidence translates directly into their financial forecasts. Amgen meticulously raised their 2026 full-year guidance. They bumped expected total revenues up to a range of $37.1 to $38.5 billion. They increased their non-GAAP EPS outlook to $21.70 to $23.10 per share. Internal expectations are rising across the board. But if you scrutinize this guidance, there are some heavy costs baked in. Capital expenditures are forecasted at a massive $2.6 billion, primarily for manufacturing expansion like MariTide launch readiness. Plus, their tax rate guidance sits between 15.0% and 16.5% amid some ongoing IRS disputes. So the revenue is going up, but the toll to cross the bridge is getting expensive. However, if you want to manufacture the next generation of blockbuster molecules, you have to build the ironclad facilities to support them. That $2.6 billion is a non-negotiable down payment on long-term yield.
That brings us to Section 5, the verdict. Forging the final portfolio call.
All right, it is time to forge our final conclusion. We have stripped these financials completely down to the studs. We've seen the ironclad growth drivers, and we've aggressively examined the rust of the legacy erosion. We've synthesized all this hard data to answer the ultimate question: does Amgen deserve a spot in your iron financial portfolio? For me, a lot of the verdict comes down to how they treat their shareholders while they actively rebuild the foundation. And that answer is $2.52 per share. That is the robust quarterly dividend they just paid out, which is a 6% increase from 2025. This is the ultimate reward for investors willing to ride out the transition. It's a highly reliable payout, completely supported by that $1.5 billion in free cash flow forged in iron. You get paid handsomely while the pipeline matures. But remember, a dividend is only ever as safe as the cash flow behind it. We have exhaustively debated the facts today. You've got incredible double-digit growth from 16 different brands, a $2.52 dividend, and raised 2026 guidance. But you are also buying into a company carrying $57.3 billion in debt, suffering a massive $1.1 billion bleed from legacy drugs in a single quarter, and facing rising cost of sales pressures. So we're leaving you with this final provocative question. Do Amgen's heavy debt and legacy bleeds outweigh its powerful dividend and pipeline growth? Is this an ironclad portfolio addition perfectly positioned as a springboard for the future? Or is the rust just too deep, making this an undeniable yield trap? Look at the structure, run the numbers, and forge your own path. Thanks for joining us on this explainer right here on Iron Financial.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.